Karen, do you buy the stagflation argument, and is the BOE headed for a mistake?
So I certainly think that these rising cost pressures and ongoing supply chain issues are going to push up on inflation. I'm less convinced it's going to materially damage growth. At the end of the day, there's still so many tailwinds. The pent-up savings, which in the UK is about 10% of GDP. The labour market is very strong, and therefore workers can probably at least compensate themselves a little bit for these rising cost pressures, and confidence on the back of rising asset prices as well. So I think the tailwinds for demand are pretty strong. Now, of course, what will happen is some of those savings are going to go off towards utility bills and petrol, and it's not that it's not going to impact growth, but I don't think that what we've seen so far is enough to derail that recovery.
Does the Bank of England need to raise rates at this point?
I think less in reaction to the recent inflation news. I think just the time is nigh, based on the economy and based on the recovery. I mean, the labour market is absolutely critical to the question of is inflation transitory or not. Supply chain, energy costs, all of that can be dismissed as transitory unless workers can clearly get a pay rise on the back of it. So the tightness of the labour market and worker bargaining power is absolutely central. And in the UK, the labour market, I think, is very tight. The furlough scheme is ending, and there are questions as to whether that leads to new workers coming off furlough and looking for work because they've been made redundant. But I don't think that is going to lead to a big freeing up of workers. I think a lot of those workers will transition back into their old roles, and vacancies are at record high. So I think it is time for the Bank of England to start taking its foot off the accelerator. And I think that's the key point, Guy. This is about easing off the accelerator. We're nowhere near thinking about the brake in this actually hampering activity.
What's the best way to position for that?
Well, I think one of the interesting charts to have a think about is gilts, and align that relative to the US 10-year and to bonds. I think what happened, if we take that chart back over 7-8 years, the UK market was just positioned with the US, very similar economies. And then we had the Brexit referendum. And I think that the market sort of said, okay, well, the UK is shifting out of the US paradigm into European. It's going to have ongoing problems, and therefore the Bank of England are probably never going to be able to raise rates similar to the ECB. I think what's happening, we're already seeing the first signs of it, is the UK is dislodging itself. It's clear it's not in the European stuck low inflation camp. It's more in the US camp. So I still think gilts look pretty vulnerable, and I think there's upside to sterling on the back of that over time.
What does that do to the traditional 60-40? Let's assume that the UK does that. A lot of people in the UK will have in their 40 quite a lot of gilts. If you are saving, if you are a portfolio manager, if you don't have a mandate that you've got to kind of run a lot of bonds, what do you do? How do you compensate or deal with the risk of the fact that we are going to see gilt prices falling, we're going to see treasury prices falling? We may not see that on the continent, but nevertheless, we are seeing bonds under pressure. What do you do as a portfolio manager? What do you do as an investor?
Yeah, I mean, it's the big investor question, Guy. You know, our bonds are supposed to be our source of protection. When there's a risk, then they're supposed to go up in price. What we're talking about is inflation risk, and therefore the risk that central banks have to more, and therefore actually our bonds are sort of central to that risk. So they're not our diversifier. They're neither our source of income, and they're neither our source of diversification right now. So where else do we go? Well, there are still things in fixed income. You know, we still think this is an environment where demand is strong, and therefore the high yield section of the market is still going to provide you that income, but it's going to be bumpy. There are areas of the stock market, thinking about what are going to be the defensive stocks in an environment where maybe the central banks are having to raise rates a bit more. Things like the financials, for example, have been terribly well correlated with what the 10-year is doing. So that would provide some portfolio insulation. But other than that, we're thinking about the macro funds. They do a pretty good job in periods of volatility, and other alternatives like core infrastructure, where your real yield is both positive and those cash flows are protected. but it's the biggest problem investors face right now. What do you do with what was a traditional 60-40 portfolio? Life's just not that simple anymore.